It is predicted that there will be a significant decrease in real estate prices will have a devastating impact on household wealth. Now, this is Investing Path, and we will be discussing the upcoming decrease in real home prices, why it's likely to happen based on trustworthy leading indicators, and what it's going to mean for the rest of the economy, and the emerging 2022 recession. Now, before we move forward, please make sure to give this video a like and subscribe, and while you're at it, click that notification bell button as well to keep yourself updated with more of our content. But other than that, let's begin. To begin, we will consider real home prices, which are prices for homes after inflation has been taken into account. Why do we care about actual housing prices rather than nominal ones? When it comes to the wealth effect, real housing prices are far more important. As a hedge against price increases, real estate is a popular investment choice. To understand it even more, let's say inflation is 10% and your home goes by 15%. This means you end up 5% richer after accounting for inflation. If inflation is 10% and your home only increases in value by 5%, you end up worse off, even if you invested in something that was designed to protect you against inflation. In addition, actual home prices are the strongest indicator of the underlying success of real estate as an asset class over extended time periods. House prices in the 1970s and now cannot be compared without taking inflation into account. Since the 1970s, the real value of a property has been plotted against the rate of inflation to indicate that real home prices have fallen multiple times, typically coinciding with economic downturns. Real estate values grew throughout the recession of the 2000s, although this was an anomaly. Real estate prices fell by over 30% in 2008 due to the economic crisis, and it took until 2021 to reach their pre-recession high point of 2006. By looking ahead 15 years, we can see that real estate home prices are rising at an annualized pace of 13% in 2021, which was higher than the peak rate of home price rise in 2006. There was a widespread misconception that home prices can go down because real home price growth was positive for 10 consecutive years, from 1996 to mid-2006. Again, real home price increase has been positive and substantial since 2012. This time, it has been so for another decade. Real home price rise over the past decade has averaged 4.5%, far greater than the 2% seen over the previous 2 decades. Homeowners and investors alike had grown accustomed to seeing their wealth grow rapidly in tandem with the appreciation of their property, especially when employing substantial amounts of leverage in the form of mortgage debt. A common belief that you can leverage your way to wealth developed along with the widespread expectation that home prices would consistently increase at a rate of at least 5% over inflation. Real estate values, however, are beginning to fall. It is true that 1 month can't be used to draw any conclusions about a long-term trend. But this is precisely where the EPB macro process really shines, and why it's so important to look at leading indicators. Even though there are many potential precursors to real estate price growth, we will only discuss 3 here. It's not enough for a leading indicator to appear a good on chart. It needs to make sense, use a large sample size and a history of success in predicting cyclical inflection points. For starters, there are currently enough newly built homes to last a whole month. The number of months of inventory on hand is a useful indicator of how long it will take to sell off all of a company's current stock at a current sales rate. This metric is similar to the ratio of new orders to inventory in the manufacturing industry. Both are measures of inventory. This makes sense, as a larger month supply number indicates a widening gap between stock and demand. Given that the supply number is reversed in this graph, a downward trending green line indicates an increasing supply for the current month. Month supply indication fell before both the 2007 price drop and the slump in real home price increase that occurred in 2013 to 2014. In terms of actual home price increases, it was the market leader in 2019. The metric also explains why actual property prices didn't fall during the recession of the 2000s, before the advent of COVID-19. No decline or disproportion between stock and sales was seen in the months of supply. Real estate price rise is expected to peak by the end of 2020, as indicated by the month supply indicator, which has recently begun to show signals of doing so. As a leading signal of future decreases in actual home price rise, the enormous mismatch in the month supply statistics of new homes shows that price growth has been overstated by nearly a year as of today. Therefore, this indicator suggests that 1 month fall we've witnessed so far is more than simply noise. Rather, it's the beginning of a new trend. The difference between mortgage rates and treasury rates is the next variable to consider. Meanwhile, the spread, which indicates risk, is far more instructive than the mortgage rate itself. Mortgage spreads widen when the spread is inverted, as depicted by the upward trend. To determine if a reduction in mortgage rates is due to falling treasury rates or narrowing mortgage spreads, we must first determine whether or not falling treasury rates are indicative of deteriorating economic conditions. Mortgage spread tightening before the recession of 2007 was a leading indicator of a turnaround the following year. Spreads predicted a slower increase in home prices in the run-up to the recession of the 2000s, but this never came to pass. This is why it's better to take a basket approach and monitor several different indicators simultaneously than to rely on just one. Since the monthly supply statistic did not indicate slowing home price growth, it is crucial to consider the entire basket rather than relying on a single indicator. Mortgage spreads are increasing significantly today, which bodes poorly for the future appreciation of property values. Finally, we'll examine the real M2 growth, also known as real money supply growth, which is more unpredictable or irregular but provides good timely signs of recovery due to the fact that extra liquidity aids the price of any asset, including real estate. Massive spikes in real M2 growth like the one we saw in 2020 and 2021 are followed by similarly massive spikes in real home price appreciation. The current state of surplus liquidity is currently not favorable to home price appreciation and is instead suggestive of a sudden slowdown in real home price rise. The rising month supply of new homes is a clear signal that builders will slow construction and lower prices of existing inventory, as evidenced by all three of the aforementioned logical and established leading indicators of actual home price rise. As the mortgage gap widens, it indicates that mortgage lenders are increasingly concerned about the stability of the housing market, and consequently, the Federal Reserve is taking swift action to restrict the availability of funds. As a result, there is greater supply, greater risk, and less liquidity. By averaging the three indicators we just reviewed, it provides a clear indication of the direction of real home price growth over time. Since we mentioned that rising property prices are crucial to the wealth effect, it is clear that the basket's aggregate signal is weaker and that reductions are beginning. Many homeowners take advantage of their home's appreciation by treating it like an automatic teller machine and withdrawing money whenever the price of their home rises by 5 or 6% annually above the rate of inflation. There's no reason for it, but many individuals rely on home equity loans and annual appreciation to turn their house into a never-ending source of wealth. One of the major assets for most individuals could be making them less financially secure if real property values are predicted to drop, meaning the home is losing value to inflation. As a result of the immobility of real estate, the majority of their wealth is inaccessible. If it's far higher than inflation, then you're getting richer without doing anything really impressive. Increased ability to buy things? If you can't access your money because it's stuck in an asset that's declining in value due to inflation, your financial situation is getting worse every day. Yale economist Robert Shiller, who is best known for developing the Case-Shiller Index, has published a study on the wealth impact. The paper concluded that rising stock prices have almost lethal wealth effect. Stock portfolios are too volatile for most people to borrow against them, and even fewer people would spend more money because their stock portfolio had increased in value. Though this is supported by the data, the study ultimately determined that there was a substantial evidence of a wealth effect in the housing market when home prices massively outpaced. Those who have experienced inflation report a significant improvement in their financial situation and a sense of security over the accessibility and security of their newly acquired equity in the form of equity lines of credit. When real estate prices fall, it will have a devastating effect on consumers' psyches and lead to a downward cycle in spending. One that is already becoming apparent with most people falling behind because of rising gas and food costs. As a result, real property prices will begin to fall, which will have a profoundly adverse effect on household wealth and exacerbate the severity of the current economic slump, which is dangerously close to recession. And that concludes our video. We hope that you learned a lot from what we have discussed today. And if you'd like to see more of this, then don't hesitate to leave us with a thumbs up and subscribe as well to our channel to see more videos about financing and personal investment. We thank you so much for watching, and once again, this is Investing Path, and we will see you again on our next video.